The stock market is about to explode upwards, and I've got the data to prove it. Despite recent volatility and tech sector underperformance, all signs point to a continued bull market. In this video, I'll break down why the upcoming Fed meeting isn't a threat, debunk the Magnificent Seven bubble myth, and reveal the economic indicators that Wall Street is overlooking. After days of research and analysis, I've uncovered compelling evidence that we're on the cusp of a major market surge. Stick around to learn why your portfolio could be in for a serious boost. Let's talk about the elephant in the room, the upcoming Fed meeting on September 18th. Everyone's expecting a rate cut, but here's the kicker. It's already priced in. The market is split 50-50 between a 0.25% and a 0.5% cut. Here's why this is actually bullish. Unless the Fed completely blindsides us with no cut or a massive 0.75% cut, we're in good shape. A 0.25% cut, the market shrugs. A 0.5% cut? We might see a slight dip, but nothing major. The real magic is in the market sentiment. We're currently neutral, not too fearful, not too greedy. This puts us in a sweet spot for the Fed meeting. Remember 2019? Last time we had rate cuts, the market initially dropped, but then soared. This time, we're better positioned. So, don't let Fed fears keep you on the sidelines. The stage is set for growth, regardless of the exact number they announce. Now, let's address the tech sector's recent underperformance. Some of you might be worried, but here's why you shouldn't be. First off, this isn't unusual. The Nasdaq tends to overheat in July, then cool off for a few months. We're right on schedule. Remember, the S&P 500 hit its all-time high recently, while the Nasdaq lagged. But here's the key. Historically, this sets up a strong year-end rally for tech stocks. Look at the fundamentals. Many tech companies are posting stellar earnings and growth projections. This dip, it's not a warning sign, it's a buying opportunity. Seasonally, September is often weak for tech, but this typically leads to a strong fourth quarter. Don't fall for the doom and gloom headlines. This pattern we're seeing now, it's almost identical to what we saw in 2023. Remember how that played out? Tech stocks soared. The same companies that people were calling overvalued then are now double or triple in price. So, is the tech sector's underperformance concerning? Not at all. If you've got a long-term perspective, this is your chance to grab some fantastic companies at a discount. Just make sure you're picking the right ones with solid fundamentals. Trust me, patience here will likely pay off big time. Let's address the elephant in the room, the so-called Magnificent Seven bubble. You've probably heard the doom and gloom predictions about how these tech giants are artificially inflating the market. Well, I'm here to tell you that's nonsense. Remember, 2023? Everyone was screaming bubble then too. But look where we are now. Here's the reality. These companies aren't just hype. They're profit machines with real sustainable growth. The AI revolution isn't a bubble, it's just getting started. And guess who's at the forefront? Yep, the Magnificent Seven. But here's the kicker. The rest of the market is catching up. The other 493 companies in the S&P 500 are projected to see significant earnings growth in the coming quarters. This isn't a house of cards. It's a strengthening foundation for the entire market. So, next time someone tells you we're in a tech bubble, remember this. Real innovation, real profits, and broadening market strength aren't signs of a bubble. They're signs of a healthy, growing market. Don't let fear-mongering keep you from potential gains. Now, let's dive into why this bull market isn't just a flash in the pan. First off, let's talk duration. If this bull market ended in July, It would be the shortest in history, tied with the pandemic-fueled run from 2020 to 2022. That's highly unlikely given current conditions. Here's what's really exciting. Market breadth is expanding. It's not just a handful of stocks carrying the load anymore. We're seeing more and more companies posting better earnings and stronger fundamentals. This broad-based strength is a classic sign of a healthy, sustainable bull market. But wait, there's more. Remember how everyone was freaking out about the Fed's rate hikes? Well, guess what happens when rates start coming down? Historically, that's rocket fuel for stocks. And we're on the cusp of that cycle now. Let's talk sentiment. We're not seeing irrational exuberance here. In fact, many investors are still cautious. That's a good thing. It means there's still plenty of sideline cash waiting to enter the market. As more positive data rolls in, that money will likely flow into stocks, pushing prices higher. Now, I'm not saying it's all smooth sailing. We'll have volatility. We'll have pullbacks. That's normal and healthy. But the underlying trend? It's up, folks. Look at the economic data. Consumer spending is strong. Unemployment is low. Inflation is cooling without tanking the economy. These are the ingredients for a continued bull run. Here's the bottom line. Bull markets don't die of old age. They die when the fundamentals deteriorate or when euphoria takes over. We're seeing neither of those things right now. So buckle up, because this bull might just be getting started. Let's tackle the elephant in the room. Recession fears. You've heard the doom and gloom, right? Recession is just around the corner. Well, I'm here to tell you why those fears are overblown. First, let's look at the data. Consumer spending, it's robust. Unemployment, near historic lows. Inflation, coming down without crashing the economy. This isn't what a pre-recession economy looks like, folks. Now, I'm not saying everything's perfect. There are challenges, but here's the key. The economy is more resilient than many give it credit for. We've weathered rate hikes better than expected. Companies are adapting to the new normal. Here's something the doom mongers often miss: the potential for a soft landing. The Fed's tightrope walk might just pay off. We're seeing inflation cool without a massive spike in unemployment. That's the holy grail of monetary policy. But let's say I'm wrong. Let's say we do get a mild recession. Here's the kicker. The stock market often starts recovering before the recession even ends. By the time the all-clear signal comes, you've already missed a big chunk of the gains. Remember, the stock market isn't the economy. Strong companies can thrive even in challenging times. And right now, we're seeing a lot of strong companies with solid fundamentals. So, while it's smart to be prepared, don't let recession fears paralyze you. The economic reality is far more nuanced and far more positive than the scary headlines would have you believe. So there you have it, folks. The stock market isn't just hanging on. It's poised for strong growth. We've got a neutral market sentiment, a Fed that's likely to cut rates, undervalued tech stocks ripe for a rebound, and economic indicators that paint a much rosier picture than the doom and gloom crowd would have you believe. This bull market? It's far from over. But here's the thing. The market isn't just about what's happening here in the US. There are global forces at play that could shake things up in ways you might not expect. In fact, I recently did a deep dive into 4 megatrends that are reshaping the entire investment landscape. One of these trends is about to reach a tipping point, and it could have huge implications for your portfolio. If you want to stay ahead of the curve and protect your wealth, you need to check out my video. Important. This mega trend will end soon. It's right here in the end card. Trust me, you don't want to miss this one. It could change the way you think about investing.